G'day, folks. I believe the best stocks in this market can achieve three things. They can grow the stock price, pay a dividend, and increase that dividend over time. There's that arguable situation of what's better, dividends or growth. And I think the best stocks should marry both of these together. And I'm going to share with you toward the end of this video 8 stocks that have done this very successfully for decades and decades, and the things you need to look for a long retirement, stabilized generational portfolio. But first, I want to talk about what we've all got sucked into from the March 2020 crash to 2022, where we've seen a wicked amount of bubbles bursting across a multitude of sectors. Now, if this is a conversation you can appreciate, hit that like button, because this should help save you a lot of headaches in doing your research when you're building out your portfolio. But we all know and have all seen variations of this chart talking about the main stages in bubbles, which is obviously the smart money, the guys that get in early, the awareness phase, where a lot of people probably aren't paying attention to it till the mania phase hits. And usually when the mania phase hits, even these early investors sometimes don't recognize it for what it is. They do not take profits. And then we move into the blow off phase, where these things capitulate back down to their mean. And honestly, a lot of these might be good buying opportunities at this point, because we're going to look at a lot of industries really quick. First and foremost, a company I was involved with during that early phase, when we're talking about the institutional investors, right? When people are not fully aware, because I was buying this company back in 2014, 2015. And obviously, we're talking about the MJ space, one of the largest MJ companies on the planet, this Canadian, what people would have thought to be a growth beast here, guys, went exactly through this bubbly phase because it's a brand new industry, and that top is blown off dramatically. Virgin Galactic, one of the SPACs, we all remember Chamath Palihapitiya, guys, really bring all these SPACs to the public market. Clear bubble that directly, again, resembles this kind of a chart, right? GME, I think this thing is still a bubble that is slowly deflating, because this is all retail and Reddit-based audiences, purely driven from hype. A lot of people will argue fundamentals, but we'll talk about those in a second. Look at MindMed. The psychedelic sector, I think, is going to be huge into the future, but all of that early day hype that came in took the stock well beyond its fundamental means, so it went through the same bubbly period. I mean, Robinhood started off with early investors that could invest privately before going public, now all selling out of Robinhood as it's come public. I mean, this one's been a wicked disaster. Hut 8 mining, we're now seeing the deflating of many altcoins, a lot of these cryptocurrencies, and a lot of the publicly traded mining companies look like they were going through a bubbly phase that is now capitulating to the downside, right? So let's talk about the Exemplifier, the top of the top that we should be using as metrics to compare to other stocks we want to buy. So we're going to talk about Apple here real briefly, because when we go into Apple's metrics, and I really want to pay a lot of attention to the EPS, the earnings per share. This does not represent revenue. This is just the bottom line that hits that free cash flow that they can use to pay dividends and grow the company and reinvest into different businesses, right? And this company has had a wicked long-term trend over a decade of EPS growth in a very stable manner. So this is the kind of chart we want to see. So up here's the stock price, EPS, and then the price to earnings, what we're paying for that company. PE ratios for you newbies out there is basically how many years it's going to take for me to get my money back based off the current EPS. So right now, Apple's trading at a PE of 23. So if the Apple doesn't grow EPS at all for the next 23 years, that's how long it'll take to get that money fully back and ready to return. But let's talk about the comparisons, right? Because here's Canopy Growth Corp. Canopy Growth Corp, guys, horrendous chart. No EPS, no PE ratio, because it doesn't show a bottom line earnings, and the stock price has done nothing but go down. Here's GameStop, where a lot of people tell me this company has an amazing future. They're getting involved in, NFTs and all this other stuff. And clearly, they haven't really, this chart does not look remarkable by any metric over a 10-year period. Virgin Galactic, another one here, guys, that's never show bottom line EPS. These are highly risky, what we would call speculations, and they should be very well mitigated in one's portfolio. There's nothing wrong with buying these kind of stocks. It's just a matter of knowing that long term there's higher risk than there may be reward, and for that risk you hope to make a better reward, but there's a higher chance you won't, so you just need to be very cautious, right? Let me use one example that's a lot harder to understand. A company called Telus. I love Telus. This is a telecom giant here in Canada. 10 years of history or longer, which is great. The stock chart's been very stable and up to the right, pays a great dividend. But when we look at the same metrics that we were comparing to Apple, guys, this EPS number is very confusing. It is all over the place. And that's because different sectors have different capital expenditures. Now, telecom, like utilities, is very capital intensive because it's infrastructure, right? For us to use our phones, they have to build cell towers. They have to build the infrastructure for 5G and fiber optics and things of that nature. So there's a lot lot of costs that come into play. But how is the stock price going up in a period where the earnings, that bottom line free cash flow, has been going down? Well, that's because this company has been investing a lot of capital, and we can see it by looking at their revenue. Now, if we look at this chart here, guys, this represents the quarterly revenue, and we can see it's been going up pretty dramatically over the last couple of years here. And that's because, they've been doing a good job reinvesting capital, getting new users, and doing a good job with that investment, right? So usually we can give up EPS if it's going to lead to more growth into the future. But these are companies that are, again, harder to understand. So you need to be careful with them because a lot of people don't really do the due diligence probably required. And again, it's not as clean cut as Apple. But at the end of the day, all of this will bake down into dividend growth, which is primarily what I'm looking for. And Telus has been doing this basically every other quarter now for the last, for the last 10 years, really. They've been a dividend growth beast. But here's some stocks that I don't talk about so often that I recently had a discussion with Lior, the CEO of Wealth Research Group, $1 million investor, and he shared a few stocks that I found really interesting, like Roper Technologies. This company's stock, again, goes back for decades, a lot of history, what we want to see in an industry that, doesn't experience the same hype or those parabolic phases that we've seen with these nuanced industries, right? And Roper, again, very similar to Apple, has incredibly stable EPS growth over time, hitting record EPS into the future, which has really driven down their PE ratio, making me think Roper Technology is probably a pretty good buying opportunity. Now, dividend, obviously not as substantial as something like Apple, but again, the dividend growth is, oh my God, unbelievable. If we go back to 2013, they were paying 16 cents. So in a 10-year period, they're now paying 62 cents. I mean, that's over a threefold increase in the dividend, right? Unbelievable growth. Now, this company, guys, does a whole bunch of technologies for a bunch of different sectors. They're like a software company. For instance, here's some of their portfolio companies like Aderant, if I'm saying that correctly, headquartered in Atlanta, is a global provider of comprehensive business management software for law and other professional service firms with over 35 years of history as a global industry leader. So this is dealt in the lawyer and, the law aspect of things. But look at Alpha. Like, here's a whole different one, right? Alpha Technologies is a global leader in precision rubber and polymer laboratory instrumentation, data acquisition, and data analysis software systems. And this is just two of their portfolio companies. This is a $1 billion conglomerate that is absolutely incredible, that fits kind of everything that we want to look for in, stocks that really we should be buying for a long-term portfolio, right? Here's another one, ResMed, that Lior mentioned. And this one builds those CPAP, those breathing machines that not only were probably really useful during the pandemic, but I know, like my uncle and many old people that have problems with breathing have to use these to help them sleep, right? And we can see this company, again, over a decade of history, incredible EPS that, again, looks very reminiscent to Apple's. We always want to compare this to something like Apple because that's how we know we're buying a good company, when those charts really do line up, right? And again, we're seeing the PE ratio come down, and again, might be a great buying opportunity. Now, this company, same sort of deal with the dividend history from 25 cents in 2013 to where we sit today at 42 cents, basically a doubling almost of the dividend with a current payout of 0.86%. Again, not nearly as high of a dividend, but it meets all the facets that we want for a long-term growth portfolio. And again, guys, we all know the CPAP machines. I don't think I have to go into this one as in-depthly as we did with Roper, but if you guys want to learn more about stocks like this, I have to give Lior a lot of respect. The guy went through so many incredible companies and put them together in this little blog post here. Ultimate forever stocks. Hold, add more for the remainder of your life. I passionately love this statement because in this bear market, I've noticed a lot of people stop buying their favorite stocks like Apple. Heck, some of these that we mentioned that are in this article like Roper and ResMed, because they're just scared that the stock's going to keep going down. But the whole point is you're going to hold these companies forever, and you want to hold them at better and better prices. So you should cost average into them the same way you would do with an ETF. And I think everyone should have ETFs as a proponent of their portfolio as well. That's how I balance my portfolio. And when my favorite stocks drop, I keep buying more here, folks. Now, there's 8 stock picks that I think very much represent what we talked about with those Apple fundamentals in this article, and I'm going to leave the link to it so you can discover more in the description below. Sign up to it. Lior, you can go watch the interview we did a couple weeks ago. He's a millionaire investor, guys. He makes these articles at Wealth Research Group. He won't spam you. Yes, you're going to have to sign up, put your email in to get this exact blog, but it's great. I love Wealth Research Group. I'm going to continue to learn more and, learn more from Lior. He's got great stock picks, so go check it out. I'd love to know what you think about these stocks in that comment section below. But on that note, folks, I pass the question off to you. I'd love to know what you think about all of this and more. This is just a fun conversation in a very volatile period for different sectors, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.